Well, holy smokes, everyone. The bond markets right now are in turmoil after Trump has just announced the big, beautiful bill. There is lots of more government spending coming by the US government. Investors know that the US government fiscal situation is going from bad to worse. They know there is no way the US government can repay back their debt. And the bond market vigilantes are back, and they are saying enough is enough. The US dollar is tumbling because people are starting to lose faith in the US government being able to repay back their debts. And this is not just happening in the US. The global debt markets from all these governments spending like crazy are getting out of control. But don't just take my word for it. In this video, I'm going to show you the news, the facts, and the data. Why the US government, we already know they've been in really bad fiscal situations. We already know their debt is really bad, but why it's now getting very, very severe. So everyone, without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay, first things first is this, everyone. Unsustainable. The fiscal situation. Wall Street braces for more bond market turmoil as Trump tax bill stirs up deficit concerns. Now, it doesn't matter what side of the political spectrum you are. Both parties, both governments, pretty much every government now in today's political environment has to spend big in order to get elected. It's a massive, massive problem that we have to come to terms with. Otherwise, if they keep on going on this spending frenzy, we will see governments start to default and we will see currencies fail. It's just that the US has the world reserve currency status, so they've been able to kick the can down the road longer than other countries can. But I'll go ahead and pull up this chart here, and this is quite alarming, everyone. This is the 30-year Treasury yield near its highest levels since when? 2007. Now, what happened after 2007? It's actually approaching nearly 20 years now. I think before you know it, I'll be doing videos about how the 2008 subprime mortgage crisis was 20 years ago. But we can see things are not looking good. And why is this happening? Well, this is what's happening, everyone. Rising bond yields give stock market investors the yips, so we need to watch these levels. So what are these levels that they're talking about? Let's dive a bit deeper. Well, this is what happened. A poorly received 20-year Treasury bond market auction on Wednesday amplified the concerns, highlighting worries over demand in the face of rising supply. The jump in Treasury yields spilled over to stocks, leaving major indexes sharply lower. So this is Economics 101. If they keep on increasing supply of these government bonds, aka government debt, this is an IOU, they will sell you a bond and promise to pay you back with interest. But if they go bankrupt or if they default, well, then you may not get your money back. Now, this has been a very unlikely scenario over the past 100 years, but it now is starting to become more and more likely, and bond investors are now starting to price this in. So it says here, bond investors worry Trump's big, beautiful tax bill and the impact it will have on the US overall deficit. Now, we saw something similar happen to this in the UK last year with Liz Truss, where she tried to introduce a lot of tax cuts. So pretty much spend more, have your income go down. Well, then we all know what happens with that. Your fiscal situation will just get worse. Markets are a matter of alternative. They inherently cross sectoral and cross asset. When longer bonds start to look like 5% with a 5% yield with modest inflation, two things can happen. Greedy investors reassess their equity position to get more fixed income, and carry and spooked investors reassess their equity position to go into cash. So pretty much what this means is, if you can get a guaranteed 5% return in a bond, or nearly guaranteed, unlike what we're seeing now, why would you risk, going for a 7 or 8% in the indexes in the stock market? Or you may say, look, both the bond market and the stock market for these highly inflated, not all stocks, but just the major AI tech stocks that are highly overinflated right now. Maybe I'll just go into cash instead, or some other alternative assets like gold. Now, it says here, a 10-year yield above 4.5% has historically been a problem for investor sentiment, observing that the level also coincides with a 7% 30-year mortgage rate, which could put additional strain on housing demand and activity in the broader economy. And this is another big issue coming for the economy. Housing is starting to take up 40 to 50% of some people's income. But a lot of politicians keep on thinking that high house prices are good for the economy. Well, if everyone has to spend all their money just to pay their rent or just to pay their mortgage, they're not going to have any discretionary money to spend out there on consumer staples, or they're not going to have any money to go out there and spend on discretionary items like in retail. So this is a failed idea that the politicians have, that they need to keep house prices high. If they let the housing market crash, people will have more money to spend out there on other items in the economy and create employment out there, like in retail, in technology, etc. Now, it says here, rising long-term yields weren't just a US phenomenon. Again, it's what I've been talking about. This is happening around the world because long-term Japanese yields also surged, and the move shows that the bond vigilante phenomenon isn't confined to the US. Duration risk is going to be a global fiscal complacency is being repriced in real time. Exactly. A lot of these big governments just think they can just keep spending, keep issuing debt, and everybody will just keep on buying it. Well, it's all based on faith and trust. And when that faith and trust is gone, that's when you're going to see the bond markets implode. The harmony between stocks and rates is starting to fracture. And what this is all leading to is the US dollar to start tanking. So look at this, everyone. Dollar extends drop as EU tariff delay boosts risk sentiment. I'll go ahead and bring up this chart here. We can see the dollar falls as asset managers bet on decline. This is the chart of currency move and investors' net positions on the greenback. So we can see it's having some of its worst days in years. The dollar gauge has lost more than 7% so far in 2025 and is set to wipe out all of its gains from last year. When the index rose the most since 2015, investor demand for dollars is fading amid jitters over tariffs and concern over the US government finances, spurred by plans to extend tax cuts implemented by Trump in his first term. So I think it's not speculation. I think it's not doom and gloom here, people. I'm just reporting the facts. The US government is on an unsustainable path. They will default if they don't do something soon, and we all need to prepare for this. The US dollar is falling. People are losing faith in the US dollar. A lot of other countries are trying to find alternatives like the BRICS. China is trying to trade more and more in the yuan, so you need to be prepared. And what have I been preaching? I've been consistent. I've always said you want to have some gold in your portfolio because it doesn't matter what other currency will rise over the US dollar. Humans have always valued gold as true money and true wealth throughout all of history. And people, I want to show you the data that I've been doing. I've been researching on the last gold cycles, what gold has done throughout history to see what is going to happen, because right now gold is around $3,200, $3,300 an ounce. It's on a massive bull market, but I think something big could be happening very, very soon. And I call it a breakout moment for gold in the charts, because I'll pull it up now. The bull market in the 1970s saw 200 all-time highs for gold. The 2000s bull market saw just over 100 all-time highs. So what has the bull market done today? Well, we've only seen 74 all-time highs so far, and that tells me there's big moves coming. While gold spot price has seen a collective 180 new all-time highs in the past 25 years and is more than 10x'd for a century to date, appreciation of 1,233% from February 2001's low of $255 to its price today. The same cannot be said about the companies that explore for gold, develop projects, and operate mines, because the gold mining industry has faced a crisis for the past 15 years. From 2010 to 2025, exploration budgets have stagnated or declined. Deliveries have plummeted between 1990 and 2023. 350 deposits containing 2.9 billion ounces were found, but only 29 occurred post-2010, with no major discoveries, get this, since 2016. Gold production has stagnated with projections of a 17% supply drop by 2030. So again, we all know economics 101, if supply keeps falling, demand keeps rising, the price in theory should go up. And existing mines are depleting faster than reserves can be replenished. This underinvestment in new deposits is such a huge driver for a likely supply crunch, in my opinion. Mines are depleting, it is a fact. No new major discoveries, and that's another fact. This underinvestment in new deposits is such a huge momentous driver for a likely supply crunch. Mines are depleting, fact, and no major new discoveries, that's another fact. And that's why I've been so incredibly bullish on gold for all these years, and it's finally now paying off. And Wall Street banks are now finally starting to get in on the craze. JP Morgan sees gold surging to $4,000 an ounce in Q2 by 2026, and who knows, it could maybe even happen before then. So gold is booming, but a lot of these miners are lagging behind, and we haven't seen a major bull market for 13 years. While gold is appreciated by 75% from 2021, the GDXJ index has depreciated by 63%. After a decade of little to no activity in the gold M&A space, the sector is finally waking up. Because get this past month, legendary hedge fund manager John Paulson agreed to acquire 50% of the underdeveloped Donlin gold deposit in Alaska for just $1 billion. So this is the best time, in my opinion, to be looking at companies that own large known gold deposits in prime jurisdictions, and the setup couldn't be better. And everything I've just laid out is the reason why I'm working with today's video sponsor. That's AXCap Ventures, and that's US stock ticker symbol GARLF. And get this, their insiders have been buying big, and I'll show you soon. So AXCap Ventures was incorporated to make investments to rapidly capitalize on the distressed conditions of the gold industry. The management assumes that their assets, which are comprised of 5.57 million ounces of gold equivalent resources in the measured and indicated category, an additional 0.5 MOZ inferred, are valued around $6 per ounce, while peers are trading for as much as 8x, as much as 700% more, and that could be re-rated. So you heard that right, we're going to start researching AXCap Ventures right now. So their thesis is based on the case studies of previous instances in which similar situations have led to meaningful appreciation. AXCap Ventures' flagship Converse project in Nevada's Battle Mountain Trend, a premium gold jurisdiction producing 75% of US gold, is a standout. The gold project's October 2024 mineral resource estimate reports 5.57 million ounces of measured and indicated category and a 0.42 million ounces inferred, with a drill program launched in March 2025. And insider purchases totaled 1.2 million in Q1 2025, signaling strong management confidence, in my opinion. The team assembled to run AXCap Ventures have been involved in the discovery of over 20 million ounces of gold with previous endeavors, so they have a proven track record. Now here's the value proposition. Advanced gold deposits are trading anywhere between $40 to $60 per ounce. AXCap Ventures is trading at just $5 to $6 an ounce, which is absolutely insane. The company is cashed up with $10 million. Peers traded at US dollars 49 an ounce on average, while AXCap Ventures market cap translate to only $5. And the company has $10 million cash. The business model is very simple, people. Drill the properties in order to create conditions for the exit at valuations like what we spoke about before, comparable to recent ones, and that's why I love this company so much. So thanks for AXCap for sponsoring this video. What do you guys think about the situation that we spoke on today? Let me know down below. Thanks for watching. You're awesome. I'll see you all in the next video.